I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, August 8. I remember a widely prevalent slogan of the peace movement during the Vietnam War era. Suppose they gave a war and no one came. You could apply that saying to the supposed recession. What if the pundits gave a recession and no one came? Analysts who have been insisting that we're not in a recession were handed fresh ammunition with the latest U.S. jobs report, which delivered jaw-droppingly good news. The academic argument as to whether we're witnessing a genuine recession just became more lopsided in favor of the optimists. The latest economic data, especially the blockbuster U.S. jobs report for July, undercuts the argument that we're mired in a recession. But it also increases the odds of more aggressive Fed tightening. Hence the paradox. The robust economic data might not be so good for stocks. The U.S. Bureau of Labor Statistics last Friday delivered a stunning jobs report for the month of July. Take a look. The report served as a counterweight against the 2 consecutive quarters this year of negative gross domestic product growth. The U.S. economy added 528,000 non-farm payrolls in July, crushing the consensus estimate of 258,000. The headline unemployment rate dipped to 3.5% last month, topping estimates of 3.6% and matching the 5-decade lows seen in early 2020. The leisure and hospitality sector enjoyed the greatest jobs growth, with 96,000 payrolls added in July, led by robust expansion in food and drinking places. Wage growth also jumped higher as average hourly earnings climbed 0.5% for the month and 5.2% from the same time a year ago. The U.S. has now completely recovered to pre-pandemic employment levels, with total payrolls hitting a fresh record in July. The rebound took 29 months. Nearly 3 times faster than the recovery from the Great Recession of 2007-2009. These jobs gains were generated despite decelerating economic growth, rising interest rates, and weakening consumer demand. Equities have staged a robust rally since their mid-June lows, supported by waning inflation fears, falling commodity prices, healthy corporate earnings growth, and lower bond yields. Take a look at this chart. The blended earnings growth rate for the S&P 500 for the second quarter is 6.7% as of August 5th, compared to an earnings growth rate of 5.8% the week before and an earnings growth rate of 4.0% at the end of the second quarter, June 30. Blended combines actual results for companies that have reported and estimated results for companies that have yet to report. Volatility and further dips certainly lay ahead, but the bear market likely ended in June. The major U.S. stock indices last week closed higher, except for the Dow Jones Industrial Average. See the following table. Technology and other growth-oriented sectors have attracted investors again, despite Federal Reserve tightening. International stocks also have risen as Asia and Europe expect renewed demand for their exports, and the European Union finds ways to cope with less Russian oil and gas due to Western sanctions. Last Friday's jobs report came on the heels of other encouraging data. Take a look. The U.S. manufacturing sector grew in July, with the overall economy racking up a 26th consecutive month of growth, according to ISM's survey of the nation's supply executives. The July manufacturing PMI registered 52.8%, slightly down from the reading of 53% in June. However, July's figure beat expectations and indicates continuing expansion in the overall economy. Now take a look at this chart. The ISM Non-Manufacturing Purchasing Managers Index for July also showed unexpected strength, coming in at 56.7%. The Business Activity Sub-Index increased to 59.90% in July from 56.10% in June 2022. However, sometimes on Wall Street, good news can be a mixed blessing. The recent spate of positive economic news can be construed as possibly worrisome for the stock market because it stokes fears of higher inflation. The Federal Reserve is less likely now to execute a dovish pivot when it considers rate hikes again in September. Investors will now focus on the forthcoming July Consumer Price Index CPI report scheduled for release on Wednesday. The consensus expects the rate of headline inflation to moderate, largely due to the dramatic decline this summer in commodity prices. The trend in core CPI, excluding energy and food prices, will bear particular scrutiny because it's that measure that dictates the Fed's monetary policy moves. The fact is, we're already seeing signs that inflation is cooling. Most gasoline stations in the U.S. are currently charging less than $4 per gallon. This chart you're looking at shows the dramatic decline in retail gasoline prices in the U.S. Food prices are coming down as well. Perhaps it won't be a long, hot summer of rising inflation after all. In the meantime, in this volatile and risky market, where can you still find solid growth opportunities? I can sum it up with a single word: takeovers. Even the whisper of a mega merger can hand investors enormous returns. My colleague Nathan Slaughter, Chief Investment Strategist of Takeover Trader, just pinpointed a potential takeover deal that could dwarf them all. Want to get in on Nathan's next big trade? Click the URL that accompanies this video on the Investing Daily website. Well, that's it for today. Thanks for watching. And if you have any comments or questions, please don't hesitate to send me an email to mailbag@investingdaily.com.